Let's turn now to our next discussion as one of my next guests says the Fed's tightening cycle is over, but if yields will no longer be doing the Fed's job, could more hikes still be on the table? Let's bring in Julia Coronado, Macro Policy Perspectives founder, and Peter Boockvar, CIO of Bleakley Financial Group and a CNBC contributor. Welcome to both of you. Peter, I'll just let you start. And yeah, so it's sort of darned if we do, darned if we don't on bond yields, I guess, here.
Right. The rise in long end rates were tightening for them. And then how do you define the recent drop? I think either way, the 10-year yield is up about 75 to 85 basis points since the July rate hike. And mortgage rates are up similar. So at least in the housing market, the market has tightened 3 times since the July rate hike. And even when the Fed is done raising short-term interest rates, just by keeping them elevated for a while is a continuous form of tightening in addition to QT that continues on.
We also, Julia, this morning have people looking ahead into next year and talking about when, not if, but when the first rate cut will come. Are they jumping the gun?
No, I think that, in our view, the Fed is done hiking. And so therefore, the next question is how long do they need to keep rates in this restrictive territory? When will they be able to at least move the nominal funds rate down with inflation? And that's a fair question. Our own forecast is that by the May FOMC meeting, we will have core PCE below 3% on year terms. And that will be enough progress for them to say, OK, we're going to move in lockstep with the inflation trends to keep that real interest rate where it is, but provide a little bit of relief. And I think that that's, not too distant in the not too distant future. It does assume or forecast more progress on core inflation trends. But I think if we look at the labor market, it is not generating inflation pressures. We're seeing a much healthier mix of price increases and price decreases. So I think the inflation emergency is over, even if there's still more progress the Fed needs to see to actually move the funds rate down.
Do you think, Peter, that markets are jumping the gun? We had 6% rallies for the major averages last week, 8% for the Russell. Are we going to look back and say, yeah, obviously this was the start of some, face-ripping rally into year end? Or is this people hoping for a return of the past that can't return under these conditions?
Well, what are markets trained to do? And once the Fed is perceived to be done and sort of to the side, well, let's rally markets. It's just that Pavlov's dog response. But as I said earlier, the Fed is still going to be tight. Even if they cut, there's a far distance from the zero world we lived in versus even if they cut 150 basis points, takes the Fed funds rate to 4. But they're still going to be shrinking their balance sheet. And, we'll see what they're shrinking their balance sheet at the time. But it is still a form of tightening. And the tightening is global. QT is global. The rise in interest rates is global. So there is a continuous form of tightening globally as debt comes due at these much higher levels.